In sports, the old adage is defense wins championships, and it's the same for retirees living off investment income. Here in this episode, you'll learn how one investor builds a defensive dividend portfolio that can carry him through retirement without sacrificing returns. Plus, we'll hear some of the other ways he helps safeguard his nest egg. You're watching Inside Investing. Hello, everyone, and welcome to the show. I'm your host, Jason Nadek. Joining us here is Dale Roberts. He's the founder of Cut the Crap Investing. Dale, welcome back to the show. It's great to have you here again with us.
Thanks, Jason. Thanks for having me back on. Happy to be here.
Absolutely. Yep, it's a pleasure. Now, Dale, quick question for you here. Why do you feel defense wins championships for a retiree's investment portfolio?
Well, as we know, risk absolutely gets flipped upside down from accumulation stage to decumulation stage. So accumulation is really quite simple, right? We're really just trying to, as I'll write almost every week on my blog, it's about just trying to make the most amount of money while investing within your risk tolerance level, right? So some would say, it's total return for the win. When you're in accumulation stage, whether you go through a period of, 3 years of good, 2 years of bad, 5 years of good, 1 year of bad, it doesn't really matter because it all evens out in the end, right? But again, the sequence really matters when we're in retirement, because if we enter retirement and have a bunch of bad years in the beginning, again, that can absolutely completely derail. So from there, again, we do really want to change to a more defensive posture. And of course, there's many ways to go at that, as we'll discuss.
Yeah, I'm really interested to learn from you on this because, when you've got less time, that time and that sequence, as you're alluding to, really certainly can be all the more important. All right, before we get into our conversation, just a quick note to our viewers. You can subscribe to our YouTube channel, TD Direct Investing, so you don't miss an episode of Inside Investing. Make sure you let us know in the comments what you think about today's episode and what else you'd like for us to cover in the show. With that being said, let's get into it. Now, first off, can you fill us in on your approach to investing and how you're preparing for retirement?
Sure. I guess we'll go back a few years on how I started, and would admit to being a hybrid investor, if you will. So way back in the day, I was one of the sort of early investors in the ETFs, and with that, a mix of stocks. And again, it would be the traditional blue chip stocks that Canadians love, which would be, again, the big banks, the insurance companies, the telcos, and the utilities, including the pipelines. So it was a bit of a mix. But just over time, I realized that the returns were really, really good with that mix of the individual stocks. And in fact, at times, even better, and even with some lower volatility. So again, eventually over time, it just moved more from the ETFs into that basket of individual stocks. And then more research uncovered that, again, those what I would call the wide moat sectors actually did quite well and could outperform. And again, really is a situation where the wide moats were the oligopoly situations, right? So in Canada, we love to hate the banks, if you will, and the telcos for lack of competition at times. But again, not necessarily always the greatest for consumer, but it can be great from an investor perspective. And again, move to that over time, where it is now, for me, more concentrated just in the individual stocks. And for the US, again, as I approached retirement, again, more to the defensive nature. Not necessarily what we call wide moat, but would just be the defensive sectors of consumer staples and the healthcare. So again, really was a transition along the way, if you will, and then approaching retirement, just more and more of the defense.
And we've had this kind of debate in this show before about the kind of value versus kind of a growth dynamic in your portfolio. So you're, I guess you're leaning more heavily towards the value, and are you staying away from growth opportunities now that you started getting away from that accumulation phase?
My skew would be quality. So it really is quality, but again, growth is in that mix as well. Within the stocks that I hold, and I would suggest that, the Canadian component, if you will, really is more of a core, and it's a solid, and I hope it to be a rock. It is the U.S. side where, yes, I hold, a lot of the consumer staples and some healthcare, but there is some growth in there. And so I get that growth from the U.S. part as well. And I'm not going to sell them off, if you will. They're just going to create income in a different way. What you do when you have a growth stock, it doesn't necessarily mean, you have to abandon it because you reach retirement, is what you do. And it's really just rebalancing, right? Which is just over the last few years when a stock like that and a lot of the growth stocks just keep going up, 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 and up. I just set targets, set limits, and I just sell. If it goes up another 10%, sell again, goes up another 10%, sell some more. And again, that can go either to more defensive stocks, but it can go to more, again, more bonds, whether it be long-term bonds or short-term bonds, which typically work like cash. Those typically aren't used as dividends, if you will, even though someone will pay some dividends. It's really more about harvesting the capital gains and using those profits, if you will, to build the bond bucket.
Right, you've really kind of put a focus on the quality. That's interesting to hear. So thanks for that insight. Now, Dale, what are some of the inflationary conditions that you feel retirees need to be prepared for?
Well, I guess we can look back to the periods of recession. Again, we had one recently, of course, right? Which so far it's been hopefully short-lived, caused by the pandemic. And again, there's not a lot to go on historically, but if we go back to the stagflationary of the 70s, which moved into the early 80s, that's where we can see the performance of assets. And again, typically, so again, stock markets did not deliver a real rate of return during that, meaning inflation adjusted return again above inflation, right? And that would be Canadian stocks, US stocks, international. And once again, but what did really, really well was gold, commodities, and oil and gas stocks, right? So again, we can go back. There's other periods back in, again, coming out of World War II, etc. They're very, very brief. So there's not a lot to go by, but it's very consistent on what works and what doesn't. Again, over longer periods or in those moments, if you will, it's not stock markets that work. It is the dedicated inflation fighters. Again, which I'm happy to hold today and happy to hold through the recent bout of inflation because it is kept the portfolio afloat. And again, I'm glad to go to when you fill up the car to have your gas paid for by your oil and gas dividends.
There you go. That's some nice symmetry there. Where do dividend stocks fit within your retirement income portfolio?
Well, right now, being I'm in semi-retirement and probably in a good situation where at this point I don't need, because there is generous income when you talk about having banks and pipelines and telcos as a bit of a core. So for now, I don't have to sell any shares at the moment. But again, that will come into play, of course, right? Because in the end, it really is all about total return, which is the ability to harvest the dividends, but shares will be sold, and that really just comes down to the total cash flow plan, which is again when to harvest from RSP, tax free, taxable accounts, and then pensions, whether it be public and private, including again CP and old age security. But there is sort of a magic sequence, if you will, and again, the dividends wouldn't know, so you can't really just live off the dividends because it doesn't know what is the most tax efficient. It's not going to tell you to pull from this bucket first and then this bucket second, or even the rate that you would pull from that. So again, the dividends just don't know.
All right. So dividend stocks are part of the equation for you, just not the entire thing. That said, you prefer dividend stocks that are so-called wide moat businesses. What do you mean by that?
Again, it's just lack of competition, if you will, or even we could say no competition for a sector really when it's dominated by several names, right? So again, just oligopoly. It would be a monopoly if there was just one. But really, it's lack of competition, if you will, and again, just more chance that again the companies obviously still have to execute. But if you buy within or buy enough within each sector, again, if one does poorly, it's likely that someone else is doing better. So it really is about buying as many names as you're comfortable with within those sectors. And once again, um, back to the sort of the financials, telcos, utilities, pipelines, and then grocers, and then the railways as well. When you pick those sectors and the wide moat sectors, if you will, oligopoly, I mean, it does, from my research, it does increase the probability or chance that the dividends will be more sustainable. It doesn't mean that they're always going to go up too, right? There are periods where they can hold and not increase for several years. It's happened a few times. We've seen it in telcos, we've seen it in pipelines. So it's no guarantee, but from my research would suggest that we can increase our chances or probabilities that you will still have a pretty good stable income flow and a good chance of increased dividends. For me personally, when I moved to the style and even again, including the US style, over the last decade, I haven't experienced a dividend cut, which is nice, and that includes again, many Canadian stocks and 20 U.S. stocks. So now with that, I probably jinxed myself, but it's a pretty good record considering that most of the again, underlying ETFs and indices have experienced some cuts.
Now, why do you feel it's important to build your portfolio with a wide moat stocks in defensive sectors as you head into retirement?
Yeah, again, really, it just comes back to that sequence of returns risk. That the idea and the hope is that they will go down less in a severe recession, and again, so you have to sell less. And again, fortunately, too, in Canada, a lot of those, if we go to those sort of core of the telcos and the banking and the pipelines and utilities, again, there is good income in there as well, right? So if we're getting some good income support, there is less need to sell off some shares. And again, same thing with the consumer staples and the healthcare in the U.S. I've done some research where I go back and look at past recessions and severe market corrections of the dot-com crash and the financial crisis, and it is the consumer staples and the healthcare that typically hold up pretty much in the area of 1, 2 as being top. So it really is, if they go down less, we have to sell less shares or units to provide the income that we need.
Okay, with that said, no investment's perfect, so we want to be an equal opportunity, kind of risk versus reward type of
Yeah.
approach here. What are some of the potential risks with holding wide moat dividend stocks?
Yeah, absolutely. So I'm experiencing it now, which is concentration risk, right?
Yeah.
And I beg people on my blog, I go, don't do what I do because mine's very concentrated. And I say, look to add more names within each sector. And keep in mind too that general and greater diversification is always at play, right? Whether it be avoid the Canadian bias as much as you can. Canadians are famous for overloading on the stocks that we love, but often, right? I think some of the best or many of the best companies in the world are in the U.S. They've outperformed over many, many, many decades. Once again, past performance doesn't guarantee future returns. It's just my personal observation that has happened over the past and appears it's happening now again, where again the U.S. is the top market, and it is where they seem to keep the growth, right? So greater diversification is at play, and again, there's nothing. This is just what I do, and it will always tell folks too. There's absolutely nothing wrong just with a core, well balanced global ETF portfolio that we would see even in the asset allocation ETFs. And again, as we talked about, it's not just about defensive stocks too. I still have bonds in the mix, still have cash, I still have some gold. So they all work in concert. For me, my idea is that because I have more defensive stocks, I choose to use less of the bonds and cash. So we can call them sort of bond proxies, if you will, bond replacements, but they're not going to completely, for me, replace the defensive bonds and cash. Those still have a place. So for me, just to put numbers on it, let's say if somebody was looking for a 60/40, the way I look at it is that I can do an 80/20 and have the same kind of risk profile. I can tilt a little bit more towards the equities because I do have those defensive sectors and I do have the Canadian wide moats, right? So again, the idea or hope is that there's less volatility or less drawdown in major corrections. And again, so the work of bonds really is in cash, right, is to decrease the amount of stocks that you have to sell whether under duress. So the defensive sectors, if you will, and the wide moats will work in that same.
Here's the moment of truth. Let's see how that different mix has worked for you. How has the wide moat dividend portfolio method performed against broader market indices over the years?
Yeah, it has outperformed, but it has slipped recently. So again, I don't mind bringing that on the table too. Is that because I have a concentrated portfolio and where you have some of the bigger dividend payers and the banks as well because they're facing some stress, but the telcos and the pipelines, they don't like a rising rate or high rate environment. So those are getting beat up. And because within mine, I'm not holding the lower yielding, the grocers and the railways, that would have helped and the picks that I put in my blog post, I would have done much better. So it is slipping. Now, that said, on the other side, when I talk about inflation protection, back in 2020, I started writing more about introducing or upping the level of oil and gas stocks. So those, again, because we've been inflationary, those are kind of counter to my telcos and my pipelines are getting beat up. Whereas the oil and gas stocks in those sectors, they're pretty much up like 350, 400% from mid to late 2020. So while parts of my portfolio have been beat up, they've been picked up, and by design because those are inflation-friendly assets. For now, the dividends are doing the job, but make no mistake, I need that total return in the end. And again, it really is. It is total return for the win in accumulation, and the same can be said in retirement. It's not as important because we don't even necessarily have to match the market returns, but we do want some generous total returns over time as well.
All right, well done to you and your portfolio. So nicely done. And to those watching, are you enjoying the show so far? Well, then make sure to subscribe to the TD Direct Investing YouTube channel. And if there's a topic you'd like to learn more about, let us know in the comments. Plus, follow us on X at TD_Direct Invest to get a sneak peek of upcoming shows and a ton of other content designed to help build your investing knowledge. All right, now, Dale, to your point, dividend paying stocks have generally been beaten up as interest rates have risen and underperformed the broader market as of late. To your point, dividend paying stocks have generally been beaten up as interest rates have risen and underperformed the broader market as of late. How concerning is this to the retiree who relies on that dividend income?
It does introduce the risk, right? And again, those types of stocks do really, really well in a disinflationary, low inflation environment, right? And there's no guarantee that we're done. So if we look back to the inflationary periods, we had the shock recently. The one that many might be familiar with too, which is the stagflation of the 70s area moving into essentially was over in 81. That would be a period too where you need those inflation friendly assets, which again was the gold, oil and gas stocks, and commodities all in the mix to do their job, right? So for me, that's why again I feel covered today because I am holding assets that will be inflation friendly. Not everybody has that. Some people will just concentrate on those big dividend paying sectors, and there is risk. So for me, I like to have the inflation protection. You could point to that there's an argument for the greater diversification of the full basket, whether it be the TSX 60 or TSX 300, or again, the S&P 500 or other sort of full basket of US stocks.
Now, you've talked a lot about the importance of having diversification outside of just dividend stocks in your portfolio. So, what's your approach to adding those types of investments to help smooth out your overall performance?
So again, one can take a basket of commodities is known to perform really well because again, those are the input prices, right, that are actually creating the inflation. So, and those can just again, you're owning a basket as the price goes up, the value of your portfolio, or whether it be an ETF or a fund, is going to go up in value as well. Gold is another one, gets criticized as not having a perfect record because there are certain types of inflation, and usually when it's more modest, that they don't necessarily work. But when inflation really, really hits, gold has a very, very good record. And if we look back to the stagflation area, I believe gold almost went up tenfold um, back in stagflation and again the 70s period. Another one too would be oil and gas stocks. That's known as the most reliable sector, if you will, if we're looking for equities, that the oil and gas stocks. And again, we see that once again, right, in the period from 2020, 21, 22, where that has been one of the top performing sectors. And even REITs are typically known, again, these are real assets, right? It's really the real assets that perform well when we hit inflationary. They haven't done as well recently, which again, paints a picture and I guess gives an argument for greater diversification, even if you're pulling a basket of inflation fighters, because every correction and every economic condition is unique, as we know, and real estate is really taking it on the chin these days. Thanks to the rising rate environment, but traditionally REITs as well are also a good inflation fighter. And again, it does make an argument beyond, again, just wide moat stocks or the defensive U.S. sectors that have a good basket of cash and bonds to spend from. Because again, there's lots of studies that show people find it hard to sell stocks, but easier to sell cash. And I wouldn't argue with anyone who would say I'm going to enter retirement with 5 years of total spending needs in cash and bonds, especially with the rates of the day that we have. And again, it doesn't mean that you're only going to enter retirement and only spend from those. It's just you have that basket there. It just gives you that emotional out and that financial or mathematical out that you can sell from those buckets that are necessarily more guaranteed compared to the stocks.
Is that because people have a bit of like an emotional attachment to the stocks they've held on to for years, or is there still like long-term planning or growth expectations, or in that kind of
That's a
equation?
good question. I've done some reading on that, and you hear anecdotally, like on Twitter X, we'll talk with lots of advisors who have clients with good amounts of money or even just modest sums too. And even with and talking with some dividend investors, they find it really hard to just change because they love them so much, right? Like Canadians and a dividend investor especially, they're kind of ravenous about. They can't wait to get new monies in the dividend income and just plow it into what they call that snowballing, right? So it's just a different kind of idea to take it, either not just even spend the dividends, which is obviously it's the inverse of plowing them back in, but then to actually sell those stocks, right? So they'll kind of call it like killing the cow, if you will, that delivers the milk, right? And it's just it's a emotional kind of switch that has to be turned on. And again, I think it is really just even sort of the mathematical impression too of watching your portfolio go down in value. It's normal to be able to sell, if you will, when the stock markets are going down and when your portfolio is going down. If you want to keep your spending level up, you'll actually have to learn how to do that. And it's not easy.
You mentioned Canadians tend to have a bit of a home country bias when they're investing. In your opinion, how much home country bias may be too much for somebody in retirement?
Uh, um, I don't mind, if somebody's in the, 30%, 40%, even 50%. There are studies that show 30% Canadian stocks might be a bit of a sweet spot because it is our currency and it is where we live. But I think, yeah, you can run into trouble when you get into the 60, 70, 80%. And we even see people in the 90% or more, right? And again, the risk really there is currency for one, because we don't know what's going to happen with the Canadian currency. And again, just keep in mind that Canada is not, you know, a great percentage of the world market, if you will, and it's not a very diversified stock market, right? There really is a lot of financials and resource stocks. So again, we do need to go to the U.S. We need to go to global to get that greater diversification.
Do you use dividend reinvestment in your accounts, or do you have a different way to go about that?
You meaning the drips, or?
Yeah, Europe, yeah.
Yeah, no, I typically have had a rule where not always, but I would just when it was more in the accumulation, I would just throw again new monies and dividend income that might have accumulated. I would just look for the most beat up stocks, typically value investing, right? So it's kind of like that. Done a post on the beat the TSX portfolio, which again is a big dividend approach, but it really is a value seeker where it's just looking for the most beat up stocks, right? So I followed that style, if you will. Um, it doesn't always work because sometimes something beat up stays beat up, but for me, I didn't mind that style, knowing the success of sort of that style of index, if you will.
All right, Dale, thanks so much for sharing your perspective on the value of defensive dividend stocks in retirement. Now let's take a moment to hop into Webbroker to show our viewers how they can track down wide moat dividend stocks to consider. Based on our conversation with Dale, there's three key pieces of information I want to help you be able to find here in Webbroker. One, where to find information about a company's dividend. Two, how to get information about the company's economic moat. And then three, how to scan for stocks in certain defensive sectors outlined by Dale in our conversation. All right, first off, the dividends. We're going to go to the research tab at the top of the page. Under investments, we'll choose stocks. To find out if a company pays a dividend, the easiest way to do that is to identify if there's a yield quoted. On this particular stock, the way that we can do that, if we scroll down on the right-hand side, we have some commonly used fundamental information that's available for our analysis. The dividend yield is going to be your tip-off that the company's returning some of its revenues back to its shareholders. Now, keep in mind, it is not an obligation of a company to pay a dividend, so this is why you'll need to confirm here on this particular area. To get more information about the company's dividends, we can scroll back to the top of the page and then click on the Events tab. On the Events tab, we can choose dividends to really look back at a broad range of historical information. We can find the per share amount. We get the ex-dividend date, which is the date you need to own the stock prior to that to ensure that you're going to get the dividend when you make your purchase. You get the payment date as well as the annual amount. All right, now moving beyond the dividend, let's focus on economic moat. We have a report that helps us identify how wide that moat can be. That can be found under the Reports tab near the top of the page. And then from here, the report we're after is the Morningstar Analyst Report located near the top of the screen on the right-hand side. If we go ahead and choose that report, you'll notice that it's going to pop up on the screen. If we go ahead and maximize that, I'm going to have to do a little zoom in here for everybody so we can see exactly where we're looking at. We're able to identify just beneath the company's name towards the middle of the screen, there is an economic moat section, and we can see for this particular security, it happens to have a wide economic moat just in line with what Dale was referring to earlier. All right, the next thing we're going to do is take a look at how to screen for stocks in specific sectors or industries. We'll do that first by going to research at the top of the page. Then under tools, we'll notice there are screeners. In the screeners area, we can screen for stocks, technical events, as well as mutual funds and ETFs. There is pre-built screens made by experts, as well. You can look at community-based screens that are from other users of the web broker platform. We're gonna click on screening so we can create our own custom screen. Now, what we're gonna do first of all is clear out the base screen that's in there. After we've cleared that out, we can go ahead and start choosing more criteria. What I want to focus on here for our purposes is sector and industry. From here, if we scroll down, we get to see a highlight of all of the major sectors present in the market. If we go ahead and clear off this, we can then start to tailor the results back to what we're looking for. So we've talked about banks being part of the defensive sector. We talked about healthcare. Even utilities being part of the sector. We can either go ahead and choose the sector at large, or if you hit the drop-down menu, you're able to pick specific areas of the sector. Let's keep this screen fairly broad, and we can go ahead and edit it from there. After we've chosen the sectors that are to our liking, at the top of the screen, you'll notice you have the opportunity to also narrow down the screen by either a geographic location or a particular exchange that your stock is trading on to help really make sure this is in line with your overall investments. Let's just choose Canada for this purpose, and we'll notice that after that's been done, that will immediately adjust the number of matches just based on the criteria we've added on. If we wanted to go ahead and add in dividend information to the screen as well, that's something that can be accomplished by clicking back on the More Criteria button. And then we can go ahead and identify the dividend yield on the right-hand side. And in this point, we get the opportunity to select the minimum or maximum dividend that we're looking for. You can either type in the boxes here, or you have the ability to move the slider left or right to ensure that you're capturing all of the criteria that is most important to you. You'll notice that we went from 496 matches down to 110 matches in the sectors that we've selected with the dividends of our choice. From there, it's about digging in, doing some further analysis, but that's a quick way to see all of the information that we've talked about in our informative discussion with Dale. Okay, we're going to have to leave it there, Dale. Any final thoughts you'd like to share with our viewers?
No, I would just say, check out my blog, Cut the Crap Investing, if you like, and feel free. I do answer questions, so there's a contact form. If you can't find the post, again, go find the wide mode stuff. There's a search button on there. And again, I'm just love chatting with investors, whether it be accumulators or retirees, and we'll answer all questions as they come through.
Great. Well, I've enjoyed chatting with you here today, Dale, and I know I've learned a lot personally. So thank you once again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. We'll see you all next time. Have more questions? Check out the links to the right and in the description below.